Okay, welcome back everyone. So we are going to work on the rest of question 2. So I just had a question regarding the exam. No, your exam is on the 6th of October, 6th of December, but I wanted to know if I can do on the 2nd of December, if I can do an exam prep session where we, similar to what we're doing today, work through an old test paper or exam paper prior to your writing. So my question was whether that would work based on when you are writing your other exams. But what I'll do is I'll send out an announcement on VC Learn, and then you guys can, with a form just where you can fill in the questions for me so that we can see if it would suit majority. So then you guys can look at it when you're at home again and have time. Okay, so after going through the actual information, now we are going to do the physical calculation in Excel. So I'll do it in Excel here so that all of you can see it and then go through each and every component. So the first component you have to do is you need to know this framework. So you'll see I've indicated the framework. I've done gross income less exemptions. That gives you the income amount less allowable deductions. Now, because there wasn't anything for taxable capital gain, I didn't add that line in there. Then you work out your taxable income. Now, they want you to work out your net tax payable at the end of the day. So how much money is payable to SARS. So that means we have to work out the tax liability, which would be your normal tax amount less any provisional taxes that you might have paid. Okay, so the first step you do is just go write the broad framework, and then as you go through the information, you slot them in where they need to go. So 4.1, we set the sales amount. You will now go include it into your gross income, but you will split it between local sales and your exports. Okay, now the reason for that is we said the local sales would be calculated using that 7.8 million, and we will multiply it with 100 over 115. So we are literally removing the VAT component out of that amount to work out what amount should be included, and that is the 6.8 million in our taxable income calculation. Then part 2, we said the amounts that we sold to customers in New Zealand and Canada is zero rated sales. So that means, so included in the inclusive amount is VAT of 0%. Okay, so that means I do not actually have to go work out the VAT component. I just give the actual amount as is. Okay, because the VAT was 0, it would not have looked any different. So if you did not know the difference between the two types of sales based on your VAT rules, you would have had one of the two incorrect. Then point 2, we said, was the dividends that was received of 68,000. So you include that in your gross income as dividends received. But then I also said, because of the fact that it's a dividend for various listed South African companies, we also get an exemption for that same amount, because the tax would have already been deducted when they paid out these dividends and distributed them to the companies or individuals. So you would then include, like I said, you included here in your gross income, but you also included under your exempt income. So you can only take something under exempt income or exemptions if the amount was previously included in your gross income. Then for point 3, we said it is very important that you note which is the lower of the market value of the cost when you do the deductions for your trading stock. Now for trading stock, we deduct I will load this on VC Learn for you, but okay, are you guys, can I go on? Okay, yes, I will slow down so you guys can make notes. Okay, do you quickly want to make your notes and then just tell me when I can go on? I will make it available, yes. Different people learn in different ways. So some people need to write it down to remember it, others need to see it, and others need to hear it. So we try and accommodate all of you as much as we can. Okay, can I go on? Are you guys okay? Okay, so then point 3, we said the purchases. We need to, and the trading inventory. We have to do the calculation based on the lower of your market value and your cost. So when we do the trading inventory, we start with opening trading stock, which we deduct, okay, in terms of the calculation. But you use the lower of the actual cost and the market value. Now, if you look at the table that is under point 3 on your question, the market value was actually lower than the cost. So the market value was 1.2 million. So you would use the 1.2 million in your calculation. Then the next step is we deduct the purchases amount. So we deduct the purchases. Now, because it is what we've actually incurred during the year or actually paid, we use the amount as given in the question. Okay, so this one we do not have to go look at any other information. And then the last step is adding back the closing stock. So let me just write here less opening stock, less purchases, and then you add the closing stock. Now, because the closing stock also has the market value and the cost price, we look at what is the lower of the two. Now, in that scenario, the cost price was actually the lower amount, which was the 1.5 million, which you then add back to the calculation. So what we have basically done is we worked out what was the cost of the goods that we've purchased during the year and actually used in our tax year. This is what we have done. Now, further on, they told us that we've donated antiviral spray with a cost of 22,000 and a market value of 28,500 to a PBO. Now, when we donate something, it is deemed as if we've sold it. Now, in this scenario, we need to see, will it be the cost or will it be at the market value? Okay. So what do you guys think? Will we recoup it at cost or will we recoup it at the market value? What do you think will be the recoupment amount? The 22,000 or the 22,500? Okay, so I've got market value. Anyone else? You think market value? Okay, so let's quickly see what your textbooks say on page 217. Okay, if you've got an older textbook, it is subsection 4.3.8. Okay, so they say where the cost price of stock was taken into account in the year of assessment in determining his taxable income, it is deemed that an amount was recouped or recovered by the taxpayer in terms of section 22, subsection 8. Okay, so that is the cost price if it was included in the cost price in the year of assessment. Okay, in the case where the taxpayer has applied the trading stock to his private or domestic use of consumption, it is deemed to be have recovered or recouped in an amount equal to the cost price of the trading stock. So that's not applicable. Then they tell you where taxpayer has applied on the next page, 218, whether taxpayer has applied the trading stock in any other manner as set out above or has ceased to hold it as trading stock, he is deemed to have recouped the market value of the stock. And this amount is included in your taxable income in the year of assessment in which the stock is applied or no longer held. Where the taxpayer, next paragraph, has applied the trading stock for purposes of making a donation in respect of the provisions of Section 18A, he is deemed to have recouped an amount equal to the amount that was taken into account for that year of assessment in respect of the value of the trading stock, usually the cost. Okay, so because of the fact that we've donated this to a PBO, it is considered as if we've donated it. Okay, we normally look at the lower of the cost of the market value. And in this instance, the cost was the lower of the two. So it would be deemed as if we've donated it at a value of the cost rather than the market value for this, because it went to the PBO. Okay, so if the market value was less, you would have applied the market value in this scenario. Okay, then I also said, based on the information, because we do not have the Section 18A certificate, so the formal documentation, the company will not be allowed to get the donation as a deduction at the bottom of the calculation because we do not have the documentation. So that item would have appeared right before our taxable income information, but I haven't included it because of the fact that it's not applicable. Okay. And because they did not ask you specifically if something is zero to state why, I don't think they've allocated marks for it either. Okay, are you guys okay so far? Can I move on? The guys online, are you okay? Okay, if we go to point 4, that is the section where we talked about the acquisition of a trademark and a patent. Now, when we discussed it, I told you that we can only get a deduction in terms of section 11 GC if it relates to anything else except a trademark. So any intellectual property, but not trademarks. So for that portion, you would have to go split it between the two items for me. Okay, let me just scroll up so it's clear. Okay, so the first one you do is the trademark. And then if you need to supply a reason, you would say it's not deductible in terms of section 11 GC. Okay, so the feedback I received based on this is you need to know the section numbers. You need to be able to supply a reason why you include it or why you exclude it. Okay, and then you will be tested on the 2021 year of assessment. So the rates in your workbooks, you study those. And you need to know the natural persons, the rebates, as well as the interest exemptions that they've documented in the workbook specifically as well, because they can ask you a sole proprietor and include it in that. Okay, then the patent purchase, we said because the amount for the patent is more than 5,000 Rand. How do I know this? You add the 38,300, which was the cost of acquiring it, as well as the registration fee, but only 50% of the registration fee, because they said half related to the trademark, half related to the patent. So we add those costs together and then we apply the 5% to work out what is the deduction in terms of this. Okay, so that is for the trademark and the patent. Then if we move on to point 5, it talks about the research costs. Now, because of the fact that we said the research costs was not approved by the Minister of Science and Technology, it would mean that the deduction in terms of Section 11D would be limited to the 100% because there was no approval. So we only get what we've spent as a deduction as opposed to the 150% we would get if it was approved. Okay. What they could also do in a question like this is they can split the amount between pre-approval, post-approval, and then you have to know that before it was approved, 100%, after it's been approved, it would be 150%. So they can also structure it that way in a test or in the question. Okay, so make sure that you read what they tell you specifically. Then point 6, this is where there was a lot of information regarding your rentals, your purchase of land and property, and then erecting your office building. So this one you need to go break down into the various components. So the first one, which is the easiest, is your rental paid. Now, we said the rent was paid up to, in the question, due to the expanding operations in March 2020, the company purchased a property or land, and then they said the building was completed on 1 August, and then they moved into there. So that would mean our rental would have been for 10 months. And how do I know it's 10 months? It would have been from 1 October 2019. Now, if we move into our building that we've erected on the 1st of August, we would have only rented another space up to the 31st of July. Now, if you go count that, it is October, November, December, Jan, Feb, March, April, May, June, July, which gives you 10 months. And then you apply that 15,000 only for the 10-month period. So only the period that they have physically used it for. Now, in practice, what could potentially happen is you could have an overlap. You would still be allowed to deduct the rental that you've paid as well if you could not get out of the contract before that date. Okay, so that's the rental paid. The purchase of land, we say, okay, so it's the purchase of the plots of land would have been capital in nature. So I've just included it in here just so that you know. So it's capital in nature. So it would be a 0. So it is not deductible. Then we went and we built a building of 1.2 million, so office building. And that building was completed on the 1st of August, and then we moved into there. Now with building specifically, you've got your section 13 deductions. Now for your test next week, this is not in the scope, but I've included it based on what was asked based on this question. So you would have applied for the building specifically, section 13 Quinn, which relates to the office building. Now, because it was erected after 1 April 2007, then you apply a flat rate of 5% to the building. Okay, but how long have we actually stayed in there? Would we get the full 5% or would we have to apportion it? Okay, so normally with capital allowances specifically, wear and tear you apportion, you generally don't apportion at all and you get a full 5%. Okay, so in this scenario, you would not have apportioned it for the fact that we've only used it for 2 months. Okay, then if we go on with the paragraph, they gave you more information which is relevant. So they told you that the rates paid for the year amounted to 8,900. Now, in terms of section 11A, you can deduct the rates and taxes. But now, because it's inclusive of VAT, you need to go back to your VAT learning unit and go think, what is the VAT that needs to be applied to this? Now, because of the fact that it is it's a zero rated supply, so there is no VAT in it, you can deduct the amount in full. Okay, so the full amount can be deducted. We do not have to take 15% out of that value. Okay, everyone fine up to there? The guys online, are you okay? Then we go on to point number 7. So here we're talking about the legal fees that we spent. Now, in a question, they can give you multiple types of legal fees. Now, the general rule is you can get a specific deduction for legal fees in your year of assessment as long as it relates to something that is part of your trade and would have generated income that would have been included in the production of income. Now, because they tell you this legal fees was paid to draw up the contract for the land purchased, it is relating to a capital asset. So for that reason, that legal fees would not be deductible because of the fact that it provides an enduring benefit. So it is used to create something that is capital in nature. So we would actually capitalize it to the base cost when we do the capital gains tax calculation. Okay, so for your purposes now, you just need to know because it's creating an enduring benefit, it is capital in nature and you will exclude it. It's zero. Okay, then number 8, the company also started delivering their products and they purchased a delivery vehicle. Now remember, in input VAT or in VAT, we cannot claim any input VAT if something is classified as a motor car. Now, a delivery vehicle is not viewed as a motor car, so we would be able to claim the input VAT. So when we do the wear and tear calculation, we remove the VAT component. But the motor vehicle itself would be capital in nature and that would not be deductible. Okay, but I would be able to claim a wear and tear allowance on that vehicle. And they said right at the end of your question 2.2 or 2.1, when they gave you the information, they said that it is written off over a period of 4 years. So the first step is we remove the VAT. Let me just scroll it up again for you guys. So firstly, you remove the VAT component that they were allowed to claim. Then you divide that amount by 4 years. But for section 11E, the wear and tear one, you have to apportion it similar to depreciation for the actual period you've used it. So because we purchased this vehicle in the beginning of September, we would have only used it for 1 month. And then you work out the amount, and that would be 5,072 Rand. That can be deducted for the wear and tear of the vehicle. Then the other costs that were incurred was the insurance, which they also say is inclusive of VAT. So firstly, it's including VAT. Secondly, it is paid upfront. So there's 2 things you had to deal with specifically for the insurance. We had to go think, what is the VAT element? Is it a zero rated? Is it a standard rated? Is it exempt supply? to determine what is the amount I need to use specifically for my tax calculation. Then secondly, after I've determined what to do with the VAT, I need to go look what portion is prepaid to determine if it can be deducted based on section 23H rules. Okay, so let's start with the first component. So the first thing is what we've actually incurred for insurance. We take the 36,000 that I've paid and I take out the VAT component. So your insurance premiums are inclusive of VAT. It's a standard rated VAT. Okay, but now I want to work out what have I actually incurred for my tax period. So because that relates from 1 September to 31st of March, I will be able to deduct September already because that was actually incurred in the year. Then the second part of it, now I have to go document what was prepaid. Now prepaid would have been 11 months. It would have been from the 1st of October to the 31st of August would have been 11 months. Now the rules in terms of section 23H says if it's less than 6 months, I can deduct the amount in full. Now 11 months is actually more than 6 months. So that means no, I cannot deduct it. Now because we've gone through all the information, we know there's no further prepayments that have happened. So I don't have to consider any other prepayments amounts when I go look at the aggregated prepayments amount. Okay, so I've only got this prepayment. If there were more than one prepayment in the question, you would first have to go work out what is the prepaid amount that was not previously allowed as a deduction. So it's anything older than 6 months or longer than 6 months, and add that together before we compare that to the 100,000. Let me just open all of this. So the portion that was prepaid specifically for insurance, you go work it out, you show me your calculation. You take the 36,000, remove the VAT component. We said 11 out of the 12 months was a prepayment. That gives you a value of 28,696,000. Okay. That is less than 100,000 if we look at the aggregated amount of prepayment. So that is your total prepayment, everything that was prepaid for that year. Because it is less than 100,000, I can actually deduct the full amount in terms of the second provision. If I had other prepaid amounts and I added it together to that value and it exceeded 100,000, then I would not be allowed to deduct anything. Okay, so that is important to note. They can either ask it like this or they can ask it the other way around and test the same information. Okay, do you guys understand the prepaid component? They will ask this. It will just depend whether it's going to be one item or multiple. Okay, so the wear and tear. Okay, so the wear and tear is not actually in scope for next week, but I'll quickly re-explain it again. The wear and tear is basically when you use a vehicle or when you use an asset, it loses value. As you use it, it actually decreases in value. So what SAR says, because you've used that vehicle to produce income. So in this scenario, they've produced sales by using that vehicle, by delivering it to their customers. So it is something that I'm using to produce income in my business. So then they said, because of the fact that you've used that capital asset, it is reducing in value, but you use it to generate income. We will give you a capital allowance. So we will give you an amount based on what we feel is the amount you have lost per year by using that vehicle to generate income. So that 4 years, they they will tell you in a question how many years SARS allow as a write-off. Okay, you don't need to know that, they will tell you. So that is basically what wear and tear is.
So now how do we get amount?
This amount. There's your calculation. It's the 280. Okay, you take out the VAT component, then you get an amount of, sorry, I need to unhide that. So if I do it here on the side, so if you take the 280, you multiply it with 100 over 115, then the amount excluding VAT would be 243,000. Okay, so that's amount excluding VAT. Just going to scroll here to the right. Okay, so that's how you do that. Then the next step is we take this amount, we divide it by 4 years. Okay, so this is the depreciation or the wear and tear per year. Okay, so that was the 243,478 divide by 4 years. Okay, so we say we're going to use it for 4 years. But because of the fact that we only purchased that vehicle on the 1st of September, I only used it for 1 month, which is September. Okay, so what I do is I take the year's value, okay, I multiply it with the number of months, in this case is 1 month, but because a year represents 12 months, I divide it by 12, and that's how you get to the 5,000. Okay, does that make sense? Okay, the guys online, do you have any questions for me? If there's anything that you're unsure about, just type it in the chat function and just stop me, then I can repeat something. Okay. Are you guys okay online? Nakulelo, do you want me to do the depreciation again? Or the wear and tear that I've just explained, or are you happy with the explanation as I've done just now? Okay, the wear and tear calculation, the way I've explained it now, did you understand it, or do you want me to re-explain it again? Okay, let me just quickly re-explain it again. So the wear and tear, the first step is you take that 280. Because of the fact that we are VAT registered, you have to exclude the VAT component. So what I did here is I work out the amount excluding the VAT. So I take the 280,000 and I multiply it with 100 over 115 to work out what is the amount excluding VAT. Okay, then step 2. Then I go work out what is the wear and tear that SARS will allow for a 12-month period. Now they've told us in the question that we get a 4-year write-off period. So what I did is I took the value that is exclusive of VAT, and then I divided by the 4 years which SARS will allow us to write it off over. That gives me an amount of 60,869. But because we only purchased the vehicle on the 1st of September, we've only used it for 1 month in our current year. So for that reason, I have to then go take the 60,869,57 and I multiply it with the 1 month I have and I divide it by 12 because that 60,000 represents a full entire year. So now I'm just working out for the number of months I've used it, which is then the 5,072. Okay, so I've also written here that you apportion the wear and tear for the period you used in the year of assessment. We do not show it for the entire 12 months if we haven't used it for 12 months. Okay, let's go on so we can finish this before we run out of time. Okay. So then number 8. Okay, so we've done the insurance, which was the prepayment. Then our fuel amount. Remember, fuel is 0 rated. So we do not have any VAT in there. So you deduct the 6,500 as is. The repairs after the accident, that is a normal expense that you can deduct. If it was an improvement, it would have been capital in nature, but because it is a normal expense occurred, we can deduct it. Then speeding fine, we said is prohibited in terms of section 23, so it's not deductible, so it's a 0. Okay, then if we move on to point number 9, which is our staff costs. We said salaries and wages is normal. We deduct it as is. That is enough. Okay, so salaries and wages, that amount is normal. We deduct it as is. Then if we go on in that table, leave pay, we said you need to look at what portion is a provision amount, what is actually paid. So in terms of the Income Tax Act, any provisions are disallowed, which was the 8,000, so that you will not be able to deduct. It's prohibited in terms of section 23. But they tell you the remaining amount of that 32,000, if you take out the 8,000 that is prohibited, was actually paid. So it's leave that we've actually paid to our employees, so that amount can actually be deducted from our tax calculation. Then the contributions. Now you can do the contributions separately or you can do them. Okay, so we first got the annuity. Annuity we are allowed to deduct, and that is in terms of section 11C. CA. Contributions paid, that amount you can either do them separately or in the case you can add them together. Because it's the same rule that is applied to the contributions paid, I've just added the amounts together as a deduction. Then dividends paid, we said is not deductible because it is not actually an expense. Okay, so it's also capital in nature. Okay, then the restraints of trade. So I'm just going to go slowly with this one. With restraints of trade, we need to go look at the contract period and compare it to 3 years. Now, SARS says whichever is the bigger of the two will be used when working out the calculation. Now, you'll see in the memorandums, what they normally do is they show both calculations to show you the amount based on the contract value based on 3 years. And then they would say the lesser of the two is deducted. You can also in the question just write there the longer period of what the contract years are and 3 years and then do the calculation and I will give you the marks. Okay, so I've done it the way that they've explained it in the other questions to keep it the same. So the first deduction is you look at which one is the lesser of the two amounts. So we've got the 220 over the 3 years, which is based on SARS 3-year scenario. That gives you 73,333. If we take the actual restraint of trade period, which was 2 years, it works out of 110,000. Now for your deduction, you use the lesser of the two amounts, which is this 73,333. Okay. Okay, so for restraint of trade, just remember whichever amount is the smaller of the two, you would deduct. You can also think about it, whichever period is the longer. So the longer the period, the smaller the deduction would be. Okay. Then number 10. This relates to the doubtful debts and the bad debts. So I'm just going to unhide it and then I'll talk about it. Okay, so for the doubtful debts, the first thing you have to do is you have to add back the 2019 amount that they've actually provided in the question. If they do not provide an amount, you apply 25% and then work it out. Now in this scenario, it was 90,400. Then the 303,000, you apply the 25% to that amount to work out the deduction for the current year. After 1 Jan 2021, then you would apply 40%. But for now, it's still the 25% that was applicable. Then the bad debts, the loan to your employee, when we discussed it, it will not be deductible. And the reason for it is that the income was never taxed as part of your gross income. So it never touched the income line, because it was capital in nature. So therefore, you will also not be allowed to get a deduction if your employee can't repay their loans. Then the last step after you've done all of this now is you add all of it together. Oh, sorry, there's trade debtors. I forgot about the trade debtors. Okay, the trade debtors, that was the remaining amount. But included in that 60,000 was the 2,000 loan. So you take out the 2,000 loan component, and then you're allowed to deduct the full amount for trade debtors that went bad, because it would have been included in your sales amount, which you were previously taxed on. Then you add your taxable income. Now, because it is a normal company, we apply a 28% tax rate to that to work out the tax of 1.176 million. And there was no provisional tax payments, so the amount is the same. That is the liability. Okay, there's one more part. I know we've run over time. I'm just quickly going to discuss the last bit just to tell you what you sort of had to write down. So as we went through the information, we said you had to look for things where you could potentially do something to increase either a deduction or reduce the taxes paid. Now, because they said you need to write it in a memo format, when you do the question, you have to go write it in a memo format. So you write it to who it is addressed to. You can generally write from at the top, or you can do it at the bottom, and then you have to give a heading for what does it relate to. So in this memo, we are talking about methods to reduce your tax liability. Now, if they ask for a specific format, they generally give you a mark for that format. So the types of things that I identified from the information is, the first one was that if they formalize their actual research and send it to the minister to get approval, they can actually increase their deduction from 100% to 150%. Okay, so that's the first thing they could have done. Another thing we could look at is, because Kathy has shareholdings in other entities, that is the reason why she can't register the business as a small business corporation. So firstly, we have to go look at what type of companies are the shareholding in. If it is in the list that is allowed, then she doesn't have to dispose of them. Otherwise, she can dispose of her interest in those other companies so that they can register as a SPC and reduce their tax component by using the lower rates as well. And then the other thing they could have potentially done is to only make donations to registered PBOs where they get a Section 18A certificate so that they are allowed to claim that deduction. Okay, so that is more or less what I think the items were that you were supposed to actually identify based on the information they've provided to you. Okay, do you guys have any questions?
Since you said non-deduction, like when we